Well, let's get across the market open now. Kyle Ryder joining us from capital.com, direct from London. Kyle, welcome back to you as we'll get going for a new month, of course. Let's take a look at Wall Street first, where we finished on Friday. In fact, over the course of the month, Sue, record after record, and that just continues.
Yeah, and of course, it's the combination of hopes about geopolitical risk that effectively will get this deal between the US and Iran signed in fairly quick order. And then underneath all of that is just these strong corporate profits that, really investors are sort of, I guess, throwing themselves hand over fist to try and, basically capture. And that's really underpinning this, albeit fairly narrow, but still very, very strong rally that we're seeing on Wall Street. So the session on Friday was, a modest gain for Wall Street. The open for the week for Asia looks like it's going to be a little bit sluggish, but nevertheless, I mean, the momentum behind this trade is, very, very strong. And markets are, again, hopeful that we're going to get some kind of breakthrough on the geopolitical front that allows investors to continue to just focus on this very strong earnings growth and prospects of earnings growth going forward.
Yeah, so I mean, clearly investors on Wall Street mostly focused, particularly on that AI trade. So I mean, this obviously could keep dragging on just as far as the negotiations between the US and Iran are concerned, but that doesn't seem to be concerning investors at this point.
Not at all, and I suppose therein lies the risk if, we do see a bit of a rug pull, which is certainly possible. I think what's striking is that the markets seem to be buying into the sort of Axios headlines and the kind of, arguably propaganda from the US side that a deal is, quite imminent and that, we will see at least a ceasefire that will sort of extend, a peace for what it's worth for another 60 days or so. And of course, we're getting told crucially that that'll include a reopening of the Strait of Hormuz. But the Iranians haven't been, they've been reticent really about the whole thing. So we're sort of basically pricing in perhaps that propaganda, and that's what's sort of depressing some of the volatility in the markets. But at the end of the day, as you sort of noted, there is that kind of peace premium that the markets are pricing in, and then the flip side of that too is that yes, it's a narrow rally, but tech earnings have been absolutely astronomical. Just to sort of quote a figure at you, we're well and truly through the end of Q1 earnings season now. Magnificent Seven earnings were about 63% on an annual basis, tripling expectations, and the guidance going forward is just as strong. So, really, the risk is here that we get again the rug pulled on out from underneath us because what we're getting from the US side as far as what's going on with geopolitics is inaccurate, and we see perhaps the deal fall over and the markets, mechanically pricing more geopolitical risk, more volatility and stocks pull back. But again, markets are betting on peace. Underneath it all is still very strong fundamentals, very strong momentum. And, for the time being, investors are very much willing just to sort of continue to buy into that rally, notwithstanding the risks of disappointment when it comes to geopolitical risk.
Carl, meanwhile, the heat has come out of the energy market. The price of oil having fallen almost 20% over the course of May. Nonetheless, certainly policymakers still warning of the inflationary impacts, perhaps yet to be seen. We're getting more commentary, particularly from Fed members, talking about the possibility of hiking rates.
Yeah, and I think that as far as the markets are concerned, they've kind of taken off the table the prospect of interest rate cuts. And, I think it's noteworthy that policy doves, whether it be because of self-interest or because of, good faith policy making, like Christopher Waller, have, started to talk much more hawkishly about the rate prospect of rate hikes. And if you look at basically market pricing at the moment, well, we got to sort of a better than 50-50 chance implied in the Fed futures curve last week that rates would be hiked by the end of the year. We did get some of that sort of modest weakness coming through or slight signs of, a downside surprise in the PCE data last week, and combining that with some of the weak GDP figures and jobless claims numbers, the odds of a rate hike have come back down to 45%. But if you kind of look at the lay of the land at the moment, we're in a situation where oil prices didn't really move that much in the developments of last week. We'll call it a couple of percent. So you can kind of argue that a lot of the, again, peace premium is already baked into the energy market, meaning that, yeah, maybe we've seen a bit of a peak in headline inflation, but it's going to take some time for that inflation to come out of the market. We still have a very strong underlying inflation impulse too, which I would say is, largely due to, some of this sort of competition for resources due to the AI investment boom, and that's going to continue to be a driver of sticky prices. So, it still becomes a matter of, kind of when and not if the Fed hikes interest rates. The same story can be said for other central banks across the globe, with the markets pricing in hike from the Bank of Japan this week, the ECB. Cuts have been taken off the table. Markets positioning for when the next hike will be from a number of central banks. Obviously, investors are taking that in stride at the moment. But, when you look at energy, when you look at the underlying inflation impulse, the matter really is one of more or less interest rates moving higher from here, and whether equities can continue to rally through that kind of readjustment. Because as we saw a few weeks ago, when we do see a quick upward revision to the interest rate outlook, there is a bit of a repricing lower of equities, even if it is only for a few days at a time.
Now, what should we expect for the Asian session? Kyle, certainly taking a look at S&P ASX futures there, we are down slightly. How do you see the week panning out?
Well, it looks like it's going to be a pretty lukewarm start to the week. Futures are sort of pointing lower for most of the region. I think essentially we've got two things really that we'll be keeping an eye out for the most part of the week. Is that obviously it's going to be geopolitical developments, and headline risk is going to continue to drive, volatility throughout the week. The other side of it is, of course, as we just spoke about, the interest rate outlook in the United States, and specifically some of the data, tier one data we get out to kick off the new month that could sort of inform expectations for monetary policy going forward. And the most important figure of all, of course, will be those non-farm payrolls figures that we get on Friday for the month of May, which is more or less just expected to show signs of a fairly resilient US labor market. So once more, underpinning the market strength at the moment right across the globe, and a strong market sentiment is company earnings, tech earnings, the AI trade. The risks to that trade at the moment are either disappointment from the geopolitical standpoint, and that'll come down to sort of headline risk, or if we get some data disappointment that, really kind of influences, the growth outlook, or in particular the interest rate outlook. So I think that'll be the tale of the week. And at least to kick off the Asian session, there's probably going to be a little bit of, profit taking, dare I say, and a bit of treading water until some of that news actually starts to come through the wires, and we can start to price that in.